What's going on, guys? Bang, bang. The big story this week is that Silvergate Bank has decided to wind down operations and liquidate their assets. Now, Silvergate Bank is an essential piece of infrastructure for the crypto ecosystem, and they have been a great supporter of crypto businesses over the last couple of years. Now, falsely, many people will publicly claim that Silvergate Bank got in trouble because they supported the crypto industry, but that is not true. Instead, Silvergate Bank had a number of long-duration bonds and assets on their balance sheet, and as those assets got underwater, Silvergate Bank got into a position where they needed more cash than they had available, and therefore it made sense to wind down the business. To prove that Silvergate Bank did not end up shutting down because of their crypto customers, we then can move on to Silicon Valley Bank, which is in the same exact situation. Silicon Valley Bank went from about $62 billion in deposits back in 2019 to about $190 billion in deposits at the end of 2021. Now, during that time, they took about $80 billion of those fresh deposits, and they bought long-duration assets, including about 97% of that money going into 10-year mortgage-backed securities. The reason they did this is because we were in a low interest rate environment, and they needed to get higher yield. Those 10-year maturity assets allowed for them to earn over 1.5%, which sounded great when interest rates were at zero. But now that interest rates have been increased to about 4.5%, those long duration assets are trading underwater, and the banks holding them are in big trouble. Now, banks don't necessarily have to realize those losses. They could simply hold those assets until maturity and be perfectly fine. But the problem is when a bunch of different depositors show up and they want to withdraw their assets, the banks need to get the money from somewhere, and so they're forced to sell those assets at a loss. Recently, Silicon Valley Bank reported that they sold $21 billion of their medium duration assets, and they took a $1.8 billion loss on the sale. This then led to another announcement this week, which included a $2.25 billion equity and debt offering to try to shore up the balance sheet and a $500 million investment from General Atlantic. Now, customers and market participants got spooked when they heard this announcement. They had just seen Silvergate Bank wind down operations and intend to liquidate assets. They saw a $1.8 billion loss on the sale of the $21 billion of securities, and they saw a capital raise, which made them think, maybe Silicon Valley Bank isn't doing so hot. And so, en masse, people ran and started to withdraw assets, and a full-on bank run ensued. This then led to the halting of the stock and a 70% drawdown in the stock price in less than 24 hours. And now Silicon Valley Bank has hired advisors, and they're going to sell their business. This type of contagion and this type of pressure to financial organizations is because there is market intervention from central banks. When you have a market environment that has a 0% interest rate environment, and there's that artificial suppression of the interest rate, and then you whip it back up over 4% in a matter of 18 months, that causes an inappropriate ability for these banks and these financial organizations to plan what is going to happen. They don't know what to do. And so if they got caught holding long duration assets, and there's lots of people who want their money, you have a duration mismatch, both in the case of Silvergate Bank and Silicon Valley Bank. Duration mismatch is a story as old as time in the finance industry. But Bitcoin also suffering at the hands of some of the pressure in the legacy financial market. That is down about 13% over the last week. Some of that is because Silvergate Bank is supporting crypto companies, and now they're worried they may not be able to get fiat currencies into the system. And some of that is just because there's overall pressure in finance, and Bitcoin tends to be more of a free market asset. The last story of the past week that's worth calling out is that Joe Biden has a big new proposal when it comes to taxes. The specific element to the Bitcoin industry is that he wants to add a 30% tax to Bitcoin miners who consume energy. I think this is ridiculous, and we should not be selecting out certain industries and their consumption of energy. But even though Joe Biden has proposed this plan, there's a nearly 0% likelihood that it gets passed because the House is controlled by the Republicans. So keep your head on a swivel out there. There's immense financial pressure, both in the traditional market and in the crypto market. And of course, politicians will keep proposing all sorts of ridiculous plans. But we continue to watch Bitcoin produce block after block after block of transactions, and Bitcoin self-custody may be one of the safest places in the entire world right now. I hope you enjoy these updates, and I'll talk to all of you next Saturday.